Hi, and welcome to today's Mortgage Solutions Masterclass in partnership with Family Building Society. I'm Shakina Soahene, Deputy Editor of Mortgage Solutions, and I'll be moderating today's session. It will be presented by Stuart Heavens and Grace Bennett, both BDMs at Family Building Society. Thank you both for being with us. They will be discussing the later life mortgage market, looking at how flexible criteria and lending policies can address the broad needs of older borrowers and suit their various circumstances. At the end of the presentation, there will be a chance to ask Grace and Stuart questions, so please submit them into the boxes on your screen throughout the session or at the end. If you run out of time, any questions are unanswered will be responded to directly, and the session will be available to rewatch on demand at a later date. With that, I'll hand over to Grace and Stuart. Thank you.
Thank you, Shakina. So the Family Building Society branding is almost 11 years old. Last year we celebrated our 10th birthday. We're a trade name of National Counties, which is much older, almost 129 years to be precise. One of the things that we do at Family is we adopt a manual underwriting approach, which means that we can consider cases based on their merits, sometimes even if it's not necessarily within policy, and we can take a view on certain cases. As a smaller building society, we have a number of target markets that we aim to serve, such as interest only, joint borrower sole proprietor, self-employed applicants, buy-to-lets, limited companies, expats, and most recently small HMOs. But without a doubt, our largest target market is older borrowers, which makes us an award-winning later life lender. There's a growing number of older people in the UK. Now, in part, that's due to the baby boomer generation, who are now all over 60s, is 61 to 69 years old. But in part, it's also due to improvements in healthcare and living standards here in the UK and in the world in general, which increases the average life expectancy. When preparing for this presentation, I was having a look at a graph which started in 1765, and the average life expectancy in 1765 was only 39 years old. When the National Counties was founded in 1896, the average life expectancy in the UK was 45 years old. By 1945, it had grown and it was then 64 years old. And when England won the World Cup, it was 71 years old. At the turn of the millennium year Y2K, it was 77, and we're now got an average life expectancy in the UK of 82 years old. So you can see over the last kind of century and a bit how it's improved. More older people means more older borrowers, and last year saw standard mortgages increase year on year for the over 55s, as you can see per the graphs, whilst at the same time, lifetime mortgages retracted year on year. Potentially, the move from lifetime mortgages, more a shift towards standard mortgages, maybe as a result of the current interest rate environment, which sees more older borrowers seeking out standard mortgages on a normal term basis. A report I read recently suggested that over the last year, there's been a reported 59% increase in older borrower inquiries. 59% of brokers have reported an increase in older borrower inquiries, 54% expect another increase, and 93% reported that they get at least one older borrower inquiry every month. So 4 out of 5 mortgages are on a standard borrower basis to the over 55s. And as you can see at the bottom, last year there were only 1,300 RIO mortgages. RIOs aren't performing as the FCA expected. When they were launched in 2018 by the FCA, it was expected that come this point in time, there'd be about 21,000 a year RIO mortgages in the marketplace. Whereas actually, since 2018, there's been a total of about 10,000 RIO mortgages written across all the RIO lenders, ourselves being one. More lending is done to older borrowers on a standard mortgage basis, which is obviously a big area of lending for us here at Family. As you can see from this graph, most of the lending to older borrowers over 55s is to people aged 65 and up. And for the younger of the older borrowers, there will be reasonably good service in the mainstream mortgage market. When people are looking for longer terms or they're older at application, that's where you need lenders who are willing to support borrowers later in life. For example, a 65-year-old borrower with us can have a 30-year repayment mortgage term. Attitudes to interest only may have changed since 2008, but there are still those who it would be appropriate for, whether new mortgages or existing borrowers. Almost 1 million mortgages currently in the UK are either on full interest only or on a part and part basis. Prior to 2008, much more commonplace due to endowment policies or looser regulation. We're now 25 years on from the year 2000, so between 2000 and 2008, those mortgages will be coming up for maturity over the next 8 years, which may see an increase in borrowers who have reached that point where they either have to sell their home to repay the interest-only mortgage, or may need to find an alternative lending solution with a lender that is perhaps a bit more sympathetic to lending to borrowers in later life. So even if your own views may not necessarily be too keen on interest only currently, there will be clients out there, almost a million of them, that do still need servicing for the time being, or there will be other circumstances where interest only may be a more protective solution moving forwards. In terms of the driving the increase in later life lending, we've already covered that there's an aging population. I gave you a few average life expectancies, which I'm sure you found as interesting as I did. There's the maturing interest-only mortgages that were taken out at the earlier part of this century. House price growth we've not touched on yet, which means that properties that were potentially affordable a couple of decades ago may now need a mortgage in order for someone to move into in this day and age. A few more stats for you. In 1953, the average price of a property in the UK was £1,884. That's the earliest my graph went back. Just 20 years ago, in the year 2005, the average price in the UK was much higher than £1,800. It was £150,000 average price in the UK. And the latest data that I had available was December 23, which showed that the UK average house price was £284,000, which means that in the 20 years preceding, it had almost doubled from 150 to £284,000. So an older borrower in the early part of the century may be able to downsize mortgage free or buy a house without needing a mortgage. However, now they may need at least a small mortgage in order to buy the same property. There's also been a shift in borrowing attitudes. It may be that a client wants to do IHT planning and wants to raise some money out of their estate, particularly with the recent changes over pensions being involved as part of the estate. But one of the biggest reasons in my mind for an increase in later life lending is the Bank of Mum and Dad. The Bank of Mum and Dad is now one of the UK's biggest lenders in its own right. However, like a lot of banks, it requires funding. A lot of the Bank of Mum and Dad's money may be tied up in their home or another property. So the Bank of Mum and Dad may come to speak to a mortgage advisor like you, who can then come to a later life lender like us, who can then release their money so that they can then pass that wealth onto their children, so that their children can then go and buy a home of their own. Bank of Mum and Dad might just want a buy-to-let to service their retirement, or it might be that they're looking to buy a holiday home in a seaside part of the country. In terms of the background to later life lending, one of the other slides that we've put together shows the searches on Criteria Brain. Of the top searches on there, 2 of the top 5 searches were in relation to the maximum term, whether the maximum term using earned income or maximum term at the end of the mortgage in general. And one of the other searches is in relation to joint borrower or proprietor, which we can tie on with maximum term as part of our lending policy and how we can help. Next, I'd like to hand over to my colleague, Grace.
Thank you, Stuart. That was very, very insightful. So yeah, just off the back of what Stuart has just told you there, and talking about the Bank of Family, you know, it's not just Bank of Mum and Dad, it's now the Bank of Grandparents and other extended family members there that are wanting to help that younger generation of applicants. An increasing trend, and it's off the back of a survey that we did recently, where we've seen an ever-increasing trend in older borrowers using the equity in their property to gift to family members. So linking in with that intergenerational family assistance product And that later life lending, it's finding lenders who can, support with that and lend into retirement, and seeing those that have been able to gift there. And as you can see, the Banker family reached a record high of £9.2 billion being gifted to family members in 2024, compared to 8.1 billion in 2023. So there's a massive increase there. So off the back of that, what are the reasons of why that is an increasing trend? Stuart mentioned property prices are increasing, making it more difficult, and clients needing to put a bigger deposit together. We're seeing the stamp duty increase from April 2025. First time buyers are going to face an increased stamp duty cost there that they haven't seen in a while. And affordability, whilst it is easing and lenders out there are becoming much more flexible in terms of income multiples, it's still tough. Depending on where those clients are living, they're finding the affordability on their income alone, despite it still being a decent level of income, whether that's solely or jointly, the affordability is still becoming a stumbling point. So that brings me on to talk about joint borrower sole proprietor. It's alongside the later life lending and those lending into retirement. It's a big area of lending for us. And they go hand in hand with each other. So joint borrower sole proprietor, for those who aren't familiar with it, is designed for those clients who have got a deposit to put down on the property, but they're lacking the affordability. So they need that extra support from a family member to come onto the mortgage. But the beauty of this product is there is no further stamp duty fees for those family members that are coming on to support the affordability. So where we can help is we can have up to 4 applicants come onto this product, and we will use 100% of all 4 incomes. Now, what makes this product really unique is the terms that we can offer. So Stuart mentioned that we can lend to age 95. We could lend a 30-year term to a 65-year-old. So having mum and dad, grandparents, aunts, uncles, or even siblings for that matter, come on to support that affordability, it still means a greater term being available to those clients. And I think this product is why we're seeing that increase in trend there. It's a really fantastic product and how it works. It's not also just restricted to the older generation, helping the younger generation there. It can work the other way around. So going back to that later life lending space, a lot of these clients that we see have come to the end of the term with their high street lender, they're in their mid-60s, early 70s, and they think, the only option is to sell their property or to move on to an equity release mortgage. But actually, they could find the solution of having their children, for example, come on, because their income isn't what it once was when they took out this mortgage 25, 30 years ago. So having the reverse joint borrower sole proprietor option is fantastic. It's also available on interest only this way, so it's keeping the payments affordable for mum and dad. And maximum age on interest only is 89 with us, so they can still have a really good term into retirement. So in terms of overcoming these challenges and educating yourselves as broker and having these clients come to you, a lot of the time they think their only option is to sell their property or move on to equity release. And you might also think that is their only option as well, purely because there are so many lenders out there, especially sort of those high street lenders, who restrict the possibility of lending into retirement. They'll max their age at 70, potentially 75. They'll only be able to use state and private pensions. It's about understanding those specialist lenders like us, and how we can help those clients and find an alternative solution. They might move on to equity release, or they might downsize in a few years' time. Actually, they're not ready to do that today. So learning about lenders that can offer a longer term into retirement, but also understanding what income your clients have got into retirement. What pension incomes have they got? So we will use state and private pensions, but we'll also look at using, for example, or investments. And we can actually monetize those and use up to 90% of the pension pot and the investment, and then we'll divide that by the term of the mortgage to give us an income to support the affordability. But looking at other incomes, we'll also look at rental income as well. So a lot of these clients, they have their buy-to-lets in the background and they're using that as a retirement fund. We can use that to support the affordability over the maximum term that's available to these clients. So just to sort of elaborate a little bit more on the pension income there, we're a manual underwriting lender, which is really, really important, especially for these clients who have got other alternative income streams, who've got an unusual situation where you need a common sense approach to be applied. Having a relationship, and I think I'll touch base on this in a little while, but having a relationship with your BDMs is really important. Because we can discuss the cases with the underwriters as well. But when looking at the income that we can take into retirement, pensions, what is that pension income? When is it due to be received? If we've got a 60-year-old, for example, looking for a 20-year mortgage to their age 80, they might be receiving a really good earned income at the moment, but we know that our maximum age for taking that is 75, potentially 70 if they're in a manual role. So that's when we're going to ask the question of, okay, well, what do they have to support themselves as a pension income? We know they're going to receive their state pension at 67, so we can include that as a projected retirement income. But if they've got a SIP in the background or a stocks and shares ISA, for example, we can monetize that by taking 90%. And rather than me splitting this over the full duration of the term, we would ask the question of, well, when are they intending on retiring? If it's 70, okay, well, rather than me splitting that by 20 years, we in fact only need to split that by 10 years, meaning the shorter the term, the more income we can monetize from those investments and pension pots. A lot of these lenders, that take pensions, you would have seen it, they take 4, maybe 5%. We're taking 90%, and they don't need to be drawn from it, which is the beauty of how we work around those pension investments. As I mentioned, we'll take buy-to-let income, so whether that's in a personal name, limited company, we're happy to take that. And also limited company directors. So this would be someone with a well-established limited company. They have got a management structure in place. The question we're asking is, does our client need to be working in order to continue to receive an income from the business? And actually, can the business function without them? Can they take a step back at any time? And if the answer is yes, as long as the accountant is in a position to confirm that that structure is already in place, that they could take a step back tomorrow, then we can actually use salary and net profit right into retirement. And the reason why we put their limited company directors and RU region of 4 accounts is it's going back to that manual underwriting approach. If you've got someone who has maybe taken out pension contributions, we can add those back in because it makes sense. We're very much wanting to understand the bigger picture for these clients and trying to find a solution, and we will work with you to do that. It's not computer says no with us, which I think is really nice. So I think sort of taking away from what I just said there, it's understanding what these specialist lenders can offer your clients as an alternative option into retirement, and not thinking their first port of call is either them having to sell and downsize or moving them on to equity release. I know from speaking to my own brokers, those who aren't equity release qualified, they're actually referring over these cases to their contacts who are. They could actually be maintaining that relationship with the client by just looking and delving a little bit deeper into what other income and what other assets those clients have got that we might be able to use into retirement. And a lot of those clients, you might also think that Rio is a potential option. And for the right type of client, it absolutely is. But many of these older clients are failing that Rio affordability calculation. You would have all seen it before. the affordability on the surviving sole borrower. And we do the same with our Rio product, but that's why a standard interest-only or repayment mortgage is another alternative option for those clients. We will assess it on a joint basis, and we will not be looking at that surviving sole borrower affordability on a standard mortgage. You're also a lot more flexible on the income that you can use as opposed to Rio, and also the LTV that it offers. So yeah, and I mentioned a little while ago that relationship between your BDM and then the BDM's relationship with their underwriters. We can go to the underwriters with your case and sense check it with them. If we need an exception, we can apply for that. And as soon as the underwriter gives their stamp of approval against that, that's then going to support your mortgage through to completion. So looking at the criteria and how we can help, some of this I've already touched base on. So the maximum term that we can offer, we lend to age 95 on a repayment basis. Interest only and buy-to-let mortgages with us is based on term guidelines. Maximum age is 89. But what I mean by term guidelines is, for example, if you had a 70-year-old, initially we would offer them 16 years on an interest only or buy-to-let basis. And then at the age of 86, we could potentially extend that by a further 6 years, and maximum age is 89. I mentioned that the maximum age for earned income is 75 for someone in a non-manual role, and then 70 for someone in a manual position. But then we look at other alternative options for them to offer a greater term there. Maximum loan to value on our products at the moment is 80%. That includes later life. So aside from the Rio, just a standard mortgage that's available on interest only or repayment offers up to 80%. I mentioned parents and grandparents into retirement can assist their children's borrowing on a joint borrower proprietor product, and the cases are manually underwritten. Now, on an interest only basis, this is where we see majority of our later life business come from. You know, those clients have been on an interest only mortgage and they want to keep it that way. So they're trying to find an alternative option. And we are definitely a lender that you want to bear in mind here. So we can offer up to 80% loan to value with sale of an alternative repayment exit aside from sell and downsize. So if the clients have got buy-to-let properties in the background, if they've got residential properties, you know, second home, they might have pension pots, so we don't need to use all of it for affordability, then we can get up to 80% on interest only. If the security property is their only repayment exit and they do tend to sell and downsize at the end of the term, then the maximum LTV is 70% here. There is no minimum equity required and there is no minimum income. And the minimum property value is 120,000, which is our standard criteria on a minimum property value. What we are looking for is that the clients can comfortably downsize, ideally within a 5 to maybe 10-mile radius. And what we're looking for is a selection of suitable properties for them to downsize to. We will verify that by looking at Zoopla or Rightmove. So as long as we can see that that is a suitable option for them, the underwriters are happy to accept downsizing as the repayment exit. And we also stress our affordability calculations on a pure interest only basis where the term is 10 years or less. It's not really for you guys to worry about, because your BDM, they will do your AIPs for you, and they will give you the option. If you came to us and said, we want 20 years, this is the client's income and their expenditure, and we've run the figures and it doesn't quite work, then sure, I can actually come back to you and say, look, these are the variations to what is on offer to them. We will stress it at interest only over 10 years, and then we'll also give you the option of, say, a 20-year the mortgage that the client requires. And we do allow our clients to do a term extension as well. So if at any point they want to extend their term, as long as it fits on the affordability and it fits from our underwriter's perspective on that manual underwriting approach, then we can also offer a term extension for them as well. And then I will move you back on to Stuart to go through these case studies.
Thanks, Grace. So when talking about pension pots and investment funds and taking a certain percentage over a certain term, it can often get quite difficult to picture it. So what we've put together is a few slides to help you vision what we're referring to. So case study number one, example number one, is regarding large pension pots. So Mr. and Mrs. Smith want to are mortgage free, and they want to give money to their children and raise money for home improvements. The pension pot that they've got here in this example is 500 grand. So as well as the state pension, combined state pension of 20, private pensions of 4, they've got a 500 grand pension pot. Now, not all lenders will use pension pots if they're not yet drawing from it. And in this example, Mr. and Mrs. Smith aren't drawing from it. Some lenders might use 3, 4, 5% of the pension pot as standard. So in our example, where we divide by the term of the loan, we'll use 90% of the pension pot, and they wanted a 13-year mortgage term. So we divide that 90% by the 13 years, which gives us £34,600 worth of pension from that pot of 500,000. So that works out as almost 7% of the fund value as income on a 13-year loan term, and that's in addition to the state pension and the private pension of combined 24,000. So suddenly these clients, although they're only receiving 24,000 in pension income now have an income of over £58,000 based on the way that we treat the pension pots. In our next example, Mr. Jones, he's got a few income streams. He's got his state pension, he's got his buy-to-let rental income, and he's got a SIP pot. So in terms of his SIP pot, one of the things that Grace mentioned about the flexibility of our policy is the fact that we can have a look and see what term we can fit the income over, what term is sustainable for the income from that pot. So in this scenario, you call up your BDM, speak to me or Grace about Mr. Jones, and you ask for the maximum term possible. I've noticed that at his age, we can have a 20-year mortgage term. Would that fit? We then have a look at the income for him, and on a 20-year mortgage term, we can get £13,500 from his pension pot, in addition to his state and his rental. Now, in this example, it's not quite getting you what you need for him, so the BDM has a little play around with you. By reducing that mortgage term to a 10-year loan term, that's double the amount of income that would be sustainable over that term. One of the things that I didn't mention earlier is the Pension Freedom Act of circa 2018 means that clients no longer have to purchase annuities with their pots. They can now access their pensions in a much more flexible way, which means that they can draw as much or as little as they want once they start drawing from their pension pot once they're old enough to. So even if Mr. Jones isn't drawing from his pension pot, we will use the 13,500 or the 27,500 that we deem to be sustainable over our term of the mortgage, as long as Mr. Jones is happy that he will start drawing from his pension at the amount that he needs to. We don't police that or enforce that. We just require him to be old enough and willing to draw from it, and then we will apply our calculations to what is sustainable for the mortgage term, and that is the income that we will use. Now, obviously, if a client is drawing more than we deem to be sustainable, then we will reduce the term in order to make the income sustainable as per our calculation. But in this scenario, Mr. Jones was able to reduce the term from 20 years down to 10 so that he could borrow the amount that he needed, and then he was able to use his buy-to-let as a repayment strategy so he didn't have to downsize at the end of his mortgage term. And then in the last example, Mrs. Brown, she's 65 and she's still working. She's been on an interest-only mortgage of a high street lender for a number of years now. And she was hoping to downsize, but she's decided that actually she's not ready to downsize yet. State pension age has moved on. She's not as old as she thought she was going to be at the end of the mortgage term, so she wants to stay where she is. But unfortunately, her current high street lender is not willing to extend her mortgage term because they now feel that she's too old for their particular lending policy. So at the moment, she's working on a term on an income of £35,000. And we know that when she retires at 67, she's going to receive her state pension of £12,000 a year, and she's also got her pension pot of 200,000 that she's not yet drawing from because she's still working. One of the things that Grace mentioned when going through our lending policy is how we will divide it over the remainder of the term if they're not yet retired. So in this example, Mrs. Brown wants a 10-year mortgage term, but she's still working for the next 2 years because she's already told us that. So we would then divide the 90% of our pension pot over the remaining 8 years of the mortgage term rather than over the full 10. That then gives us an income of 22,500 from that £200,000 pension pot, which, including her state pension of £12,000, that then gives her a total retirement income of £34,000 £34,900 in retirement. And because we use the lower of the current or the future income, we will use the 34,900 rather than the 35,000. But that £100 a year income won't make too much of a difference to her affordability. So Mrs. Brown was then able to stay in her home for a little bit longer and then downsize in another 10 years when she feels ready to do so. Oh. So in terms of our key areas of lending, the biggest area of lending is obviously lending into or around retirement. We don't credit score. We do credit search on application, and we do want clients with clean credit profiles. We want to know that they're able to maintain the credit that they have got, but they can't fail credit score with us because we do not credit score. And obviously flexible underwriting, whereby the underwriters will review the case and the documents that you provide before making a decision. There are no computerized decisions here at Family Building Society. And one of the things that I personally enjoy about working for the family is the fact that I have got those strong relationships with underwriters. I have got direct access to those underwriters. So if I get an inquiry that may or may not fit with us, rather than saying send it in and see how it goes, we might consider, or other generic phrases, I'm able to get the information from you that I would like in order to present those cases to my underwriters, my underwriting managers, even my director of lending, and seek their pre-approval for cases before they come in. This slide is simply a group of very good looking people that are out and about teaching you all about Family Building Society. So here's your BDMs. If you go onto our website, there is a BDM finder on there where you can put in your postcode and you can find the phone number and the email address and even get a close-up picture of your good-looking BDM. At this point, I'm going to ask if there's any questions. Shakina.
Thank you very much. And I hope everyone listening found that interesting. You definitely were able to sort of paint a picture of what they can expect and the circumstances that they can come across. So I will now move on to the questions. So let's go with this one. I mean, you did mention, obviously, this is about the flexible criteria that you have in the policy. So now that rates aren't expected to necessarily change drastically from where they are now, do you feel like criteria and lending policy will have a bigger role to play in the lending space? And either of you can take that one.
I'd have been taking it.
Yeah.
So, I mean, yes, I do. For us, as you know, as a specialist lender, we naturally see, more criteria-based inquiries because we kind of sit in the middle. I like to think of those high street lenders and those really specialist lenders. So I think, and speaking to my own brokers recently, they're very much finding that a lot of their inquiries are on the more complicated side and more quirky. So I think lenders will definitely put more of I can't say the word, innovative. No, I can't say the word. Bit more of a common sense approach, I guess, to their criteria. And yeah, it would be nice to see that be the case. I think especially where sort of rates sit where they are, and I don't see them, going back to where they were. So yeah, Stuart, do you have anything to add there?
I agree, Grace. Criteria and lending policy is perhaps more important now than it ever has been. Over the last 15 years or so, we've been blessed with incredibly low interest rates, and mortgage borrowing and borrowing in general has practically been free money with the rates that have been on offer. We're now in a higher interest rate environment, and so it can be a struggle for lenders that are perhaps rate driven. And those lenders will then need to look at new avenues in order to potentially diversify in terms of their criteria and their lending policy. As a lender, I think family are quite lucky. Obviously, our clients are perhaps less rate sensitive. By the time you're coming to your family BDM, it probably doesn't fit with the typical high street lenders or the big six. So you are now looking at a lender that will find you with a lending solution rather than potentially the cheapest rate of interest. And obviously, rates have to be affordable, but in particular, as an older borrower lender, clients that you're placing with family or trying to sell the family to will have experienced the interest rates of the 80s and the 90s, albeit at lower house prices, but they'll be familiar with the concept of the higher interest rates, and I'm sure they'll love telling you how their mortgage used to be 15%, and how they used to be on variable rates. So fixing in for a 5-year product at a rate that's near high street rather than high street shouldn't be too uncomfortable for them, as long as obviously the monthly payment is affordable. And that's where the different borrowing options of longer terms up to age 95 or interest only could come into play, and obviously your advice is part of that.
Of course, thank you. And the next question, well, something I've actually come across, and some advisors are saying that the limited scope of sourcing system, so the amount of options that they find on there, make it a bit hard to have a full view of all the products that are available to later life borrowers. So what advice can you give to brokers to become more informed about the options that are on the market? And Grace, I'll put that to you first.
Yeah, I think attending sessions like this, having your BDMs come in and see you. And I know a lot of brokers will say, well, I deal mainly with vanilla type cases, and I know where I stand with those. And it's not until that specialist lender like ourselves sits in front of you and educates you on what other areas of lending that we cover, that a lot of people turn around and say, oh, I didn't realize you did that. So I think it would be fantastic if sourcing systems could pick up those fine pieces of criteria, but it's just not possible. So I think, doing things like this, seeing your BDMs and just trying to learn as much as possible is where you're going to find a home for those unusual cases.
Yeah, of course. And Stuart, do you have an opinion on that?
100%. Sourcing systems are a great place to start in terms of the costs and finding out lenders. But one of the bits of advice I always give to my brokers is to try and use minimal filters. For example, we don't filter generally if you filter for free valuations, but we do offer free valuations up to 500,000. Above that, it's a discount where we pay most of the val fee. We offer £500 cashback for owner-occupier remortgages rather than free legals. So by minimalising the filters, you can bring up a larger range of lenders. And then obviously it may bring up lenders that then aren't able to lend, which is where familiarising yourself with the lenders that are suitable for that particular client, and industry events, webinars, BDM meetings, are all ways that you can familiarise yourself with the lenders that are right for certain types of clients. And certainly the brokers I speak to, a lot of them are very knowledgeable about a lot of things, so they generally know which lenders to approach. So minimal filters can often help. Sourcing systems are great though.
Yeah, definitely. Thank you. And I have another question here is asking, do you lend in Northern Ireland and or Scotland?
No, sorry.
Is that
England and Wales only.
Okay, thank you. And you did mention this a little bit during the presentation about some of the drivers of why does it increase in sort of later life lending, but what trends have you seen to show just how varied the circumstances of borrowers are getting? So that could be changes in income, changes in the behavior, changes in what they're using later life lending for. So Stuart, I'll come to you with that.
Yeah, of course. There have been quite a number of different trends that I've seen. So circumstances have ranged from, I've had older borrowers that are first-time buyers. Perhaps they're living in council houses and they've been offered the right to buy, but they're too old for the high street lenders that consider right to buys. So I've had first-time buyers purchasing council houses or remortgaging existing mortgages to stay in their home. They've come to the end of their deal with their existing high street lender and they can't do a product transfer or extend their term, or older borrowers who are consciously taking money out of their home in order to give to family members, particularly to their children. So a whole host of circumstances there where people planning for IHT, for example. A very broad spectrum for older borrowers, Shakina.
Yeah, thank you. And Grace, have you seen anything different you've seen to what Stuart has seen?
No, I completely agree with what Stuart just said. I would second that.
Thank you. And how do you expect these trends to evolve over time? I mean, is there a sign of anything that's emerging that maybe might be bigger in the future? And how can lenders catch up with this? And Grace, I'll ask that to you.
I think it's that ever-growing house, like the house price increases and the banker family, and just trying to keep up with that. I think it's always changing. You know, incomes are not increasing as quickly as house prices. So yeah, I guess it's just as a lender as well, just trying to find the next best thing for these clients and trying to help them get onto the property ladder. I think with later life lending, understanding that people are living longer, you know, those statistics that Stuart mentioned earlier, compared to many, many years ago to now, the average life expectancy is crazy how different it is. So I think as long as lenders are staying on track with these trends, but also how reality is, I think that will be really important. What about you, Stuart?
Yeah, I think you nailed it with the rising house prices. More and more people are going to need mortgage borrowing that wouldn't have needed it before. And I think also in terms of, dare I say, inheritance tax, for the avoidance of doubt, I'm not a tax specialist, so I recommend people seek specialist tax advice. However, IHT planning, I think, will be more important, particularly with the changes such as the pension pots forming part of an estate for IHT purposes. People may look at once now raising a debt against their home to give to family as a potentially exempt transfer and help create some sort of debt to offset for IHT liabilities. And again, I will caveat myself by saying I'm not a tax advisor, so I recommend specialist tax advice. And in terms of other lenders, yeah, you know, they could update their age rules, and then slightly older borrowers, obviously people might be working later in life, for example. Not all lenders will lend to people in retirement. Won't all use pension pots, as I mentioned earlier. Obviously, Shakina, from our perspective of family, I personally hope that not too many lenders start kind of catching up with the older borrower demographic, because then that eats into our slice of the pie, albeit an ever-growing pie, as I mentioned, because of the ageing population.
Of course, thank you very much. And I think that is everything that we have for the questions. There are a couple of more sort of case-specific ones, but they can be answered sort of directly to the person asking that. And as a reminder, this session will be available on demand afterwards. So thank you both for being here with us today and for presenting and sharing the information that you do have on a later life lending space. And thank you to everyone viewing as well. I hope you all have a good rest of the day and take care. Thank you.
Thank you very much.
Take care.